Hey guys, Jeff from the Brantford Realty Group here. If you know me, welcome back. If you're new here, hit that subscribe button. Be sure to follow us on Instagram and Facebook. Today, we are back for another Mortgage Minute where we're going to delve deeper into the topics of mortgages and what is entailed. I am here again with Yar from New Door Mortgages. How you doing?
Hey Jeff, how's it going, man?
It's good. Just sporting my Zoom Let's Groom shirt.
I love it, man. I love it.
Yeah, they're a local groomer here. You guys can watch it in another video coming up in about a week. But let's get to the main topic, which is of today, which is down payment. Now, where can buyers get down payment? What are the most common sources, and sort of how much do they need in total? Because some people think they might need 20%, and that's not the case. So let's delve into it and talk about the options for getting a down payment ready for the house.
Okay, cool. So down payment is widely variable. It really depends on what property you're buying and what the intention for that property is, as well as the purchase price of the property. So there's a whole bunch of different factors that will influence that. So if you're buying a property to move in for yourself, it's going to be your primary residence, and that property is less than $1 million. You can put as little as 5% down. Now that works on the first $500,000. So 5% of the first 500 would be a maximum of $25,000. So if you were buying a $500,000 property, you would need at least $25,000.
Okay.
Now, let's say, for example, you wanted to buy a $600,000 property, right? Again, that's still under $1 million. So you need to do 5% of the first 500, 25,000. And then anything of the difference between $1 million and 500, you need 10% of. So when we're looking at a property of $600,000, the difference between $600,000 and $500,000 is $100,000. And so you need 10% of that, which is $10,000. So if you add the 25,000 plus the 10,000 to buy a property of $600,000, you need a minimum of $35,000. Now, that means that you'd have to insure the mortgage. So anytime you're putting less than 20% down, you have to insure it with one of Canada's 3 insurers, which is CMHC, Sagen, which used to be called Genworth, which I still call, it's just like a habit, and then Canada Guarantee. Not all lenders work with all of them. So, if you're coming from another property and you already paid insurance, there's a way to actually port that insurance, which is a whole other topic. But you can save some money if your broker is a little bit savvy in terms of that. But that's really, you don't need 20% down if you're buying a property under $1 million. It could be a condo, could be, starter home or whatnot, depending on where you are in the country. So, you can put as little as 5% down.
Okay. Now, what was the cases that you said, like up to $1 million? Like after $1 million, is it the guaranteed 20%? You need the 20% in order to qualify for more than $1 million?
Yeah, absolutely. Right now, at the time of recording this video, anything that has a purchase price of over $1 million is going to automatically need 20%. So there are talks with the government to increase that because the prices of homes have increased.
Every home's $1 million home now.
Yeah, exactly. So that's what there's talks about that. Whether or not that's going to come out, or if that comes out, when that comes out, is kind of all up in the air. Nothing's been officially released. But right now, anything above $1 million is automatically going to be a 20% down payment.
Okay. Now, is there any difference between where the funds can come from for the mortgage? Is it do they have to have it in their bank account for a certain amount of time, or can they just sort of throw it in, a few days before closing and hope for the best?
All great questions. So normally, most people with a down payment are going to be coming from their own savings. So savings could be checking, savings, TFSA is fine, RRSP as well. One thing to consider when you're talking about a retirement savings, there are different classes of retirement savings. There's something called a LIRA, which is like a locked-in account. That would not be able to be used for a traditional down payment, but you could use something with an RRSP. So in general, they need to be in those monies need to be in your accounts for at least 90 days. So most lenders, in fact, all lenders are governed by Canada's anti-money laundering laws and FinTrack. If you've ever been to an airport and say, hey, are you bringing more than 10 grand? That's that whole FinTrack thing. So we need to be able to show that these proceeds are not as a result of like any kind of illegal activity or terrorism or funding or anything like that. So that's why we need those bank statements. So generally 90 days is a good rule to keep in mind of funds being in there. If it's beyond 90 days, then most lenders won't ask for that, but there could be cases when they do ask for that if there's a suspicion. But generally 90 days is that average mark. Yeah. So savings, TFSAs, RRSPs are all good places. Another big form is essentially the bank of mom and dad in the form of a gift, right? So I'm seeing a lot of clients, first time home buyers and second time, third time home buyers looking to gifts from their parents. Sometimes the parents are mortgage free, and so they might actually do like a reverse mortgage on their own house. Maybe they have a HELOC that they actually borrow from and give that money if they don't have cash money. So there's other ways of structuring that, but that gift can come from a direct relative. So that's a key factor, is that gift can't come from anybody. It has to be, for it to be considered a gift, it has to come from mom, dad, or like grandma, grandpa, or sibling. Even if like it comes from the aunt, it generally is not going to be accepted. There might be an exception, but it has to be from like direct family, and it cannot be a repayable loan. So when you close and when you apply to the lender, they're actually going to get you to sign a statement saying that this is a non-repayable gift. And if it is a repayable loan, for example, then we have to take that into account into our stress tests and our debt ratios, because you're paying that back. And so that could reduce your qualification. But those are generally the main places that people are going to get their down payments from.
Yeah, you're going to basically, because you're paying more monthly, or like giving them $100 a month, they got to take that $100 into consideration and then change your ratio. And depending on how much you're paying back per month, it could really affect you. So the government's really just protecting themselves, right?
They're really out there. Like the whole stress test, people have different ideas, and whether they like it or not, the stress test, it's really an affordability measure. And they want to make sure that you can afford this, that not too much of your income is going to be going into your housing and your other debts. So there's two ratios, GDS and TDS. The TDS is really basically like all your housing expenses, mortgage, property taxes, utilities, and condo fees if you're in a condo, as well as any kind of other responsibility. So they want to make sure that not all of your income is going to be going into that, because they don't want you to be in a tight spot.
Of course, yeah. They want to make sure that you can afford it and not default on your loan. Now, I know you just mentioned, TDS and GDS, and, some people watching this, that might be, a different language. We all have our own lingos in our thing. So if you just want to go into a little bit about, the TDS and the GDS, I know there's a slight little difference, and sort of what's the threshold on each one. I know it's a percentage, but it's been a little while, so let's refresh our memories.
Not a problem. So GDS is basically called the gross debt servicing. And what it takes into account is your mortgage payment, which includes your principal repayment and your interest, as well as your taxes, your property taxes for the property that you're looking to buy, utilities. Generally, it's about $100, like an industry standard. It sometimes depends on square footage and whatnot, but it's usually about $100. And then if you're in a condo, 50% of those condo fees. And that's all divided by your gross income for the year. Okay. So when we look at that, and if you divide those, you'll get a percentage. And in general, the kind of like standard guideline for an insured mortgage. So again, insured mortgage is one where you're putting less than 20% down. The maximum that number can be is 39%. So what that means to you is that not more than 39% of your gross income can be going into servicing the mortgage, the property taxes, condo fees, and utilities. So the other number is our TDS, and TDS stands for total debt servicing. So it encompasses all the numbers from your GDS, so your mortgage payment, your property taxes, your utilities, and 50% of your condo fees if they apply, plus all other debts or financial responsibilities that show up on your credit bureau in addition to that. And again, divided by your annual gross income.
Okay.
Now that number can't be more than 44%. So no more than 44% of your gross income can go into servicing all of your financial responsibilities. That doesn't include like daycare and stuff like that. So that's like a budget part.
It's
This
just
is
like your
strictly things that
car,
you,
your
yeah,
car
that you're
or
committed to, right? Like, yeah, if you have a balance on a credit card, you need to pay that. Whether or not you put your child into daycare, well, I mean, the conversation can be had, but you know, they're thinking about that you can cancel that service. You cannot cancel your repayment of a debt. And so that's what they're talking about in terms of those debts. So 3944 are generally the kind of ratios there. And that number is all based on what we call our stress tests. So the percentage that we apply for what the interest would be, because remember, there's the mortgage payment, which is the principal and interest.
Yeah.
That's all based on the stress test, and that's a percentage that is used to make sure that you can afford this not only now, but also if rates increase to a higher amount. And that's what that means, is that stress test is just helping you realize that you can still afford this payment. Again, afford, not looking at other responsibilities that don't show up in your credit bureau, but afford this payment on paper.
Yeah.
So, you know, as stress tests change, as rates change, the way that we stress tests can be different depending on the type of loan. So I'm not going to get into that, but generally that's kind of how we base it on. That's a kind of good industry standard.
What is the stress test rate right now?
So the stress test right now is 5.25. And that is going to be used on any kind of insured mortgage.
Yeah.
If your interest rate is going to be like 3.25 or greater, then your stress test is actually going to be higher on a specific type of mortgage. So it's called a conventional mortgage. Mm-hmm. So if you're putting more than 20% down for a property that's over $1 million, if your rate is going to be higher, and we actually are seeing some of these rates right now, is that it's going to be the contract rate plus 2%. So it's when you get into that 20% range of putting a little bit higher amount, it really comes down to either 5.25, which is the stress test, or the rate plus 2%, whichever one is higher. And so now we're in the situation where we are getting those higher interest rates. And so as rates go higher, your qualification actually decreases because we're forced to use a higher stress test rate. And that can affect you. So if you're on that cusp of buying things, you want to make sure that you're sending your offer ideas to your broker and making sure that the numbers still work.
Yeah, which makes sense. So now, I think like the question was like the CMHC, you know, the insured, uninsured, how much of a difference, like, are you looking in payments between an insured mortgage and like if you got the gift from mom and dad, you actually had the 25% in order to have an uninsured mortgage? How much roughly is it extra in payments to have it insured as opposed to, you know, having the full 20%? Because like that could be the difference between someone jumping in and someone asking for a little bit of help from their parent.
Yeah, so it's a hard question to answer. Obviously, when you're going to have more of a down payment, your payment is going to be a lot lower. So you can expect that not only are you putting that down payment in, but the moment you hit that 20% threshold, generally it means that you don't have to pay the insurance anymore. And so the insurance is going to be a few tens of thousands of dollars tacked onto your mortgage. And what that happens is that that's not something that you pay out of pocket. It just gets added to your total mortgage amount. So that means that your mortgage payments are going to be higher. Okay. So if you can pay, it's spread out over the life of your mortgage, which is good that you don't have to pay it out of your pocket, but you're also paying interest on that extra insurance for the life of your mortgage kind of thing, right? Yeah. So, you know, when you have 20% down, you're going to be able to reduce your payments because you're putting more money down. You're also going to be able to reduce your payments because you're not paying that insurance amount from CMHC, Sagen, or Canada Guarantee. But the other part to that is that the moment you pass that 20% threshold, the available amortizations actually increase. So amortization is the total life of your loan. And when you're putting less than 20% down, then your maximum amortization, again, at the time of this recording, is 25 years. You cannot stretch your loan out to more than 25 years. So basically what that means, it's going to take you 25 years to pay off the original amount of money that you borrowed.
Yeah.
When you hit that 20% mark, you can actually increase it up to 30. So what that does is that shrinks your payments down even more. And that's something that like is really a really nice option. I mean, you will be paying more interest on that because it's a longer loan. But
Yeah.
if you're worried about cash flow, it's a really, really good option. And you could always be a little bit clever. And this is something that I go with all my clients, is that you can actually artificially shrink down that amortization by making prepayments. So
Okay.
there's a couple of different things that we can do. If your focus is on cash flow, you know, we can have a longer amortization by increasing that 20%. But the main thing is that if you don't have that 20%, don't stress. Like get into the market, build up your equity, 5% down for like first $500,000. You can still find something in that range, right? It might not be your forever home, but you can get in there and then you can build up equity. And what happens is like, as you build up equity, even though you only put 5%, as you build up equity, your total loan to the value of your house actually decreases because your value increases.
Yeah.
And so you can have some flexibility as you renew in future things. So get into the market. Don't, listen to 20% is the only way. 20% is the only way in some situations, but not all of them. So talk to your broker.
Okay. Yeah, that makes sense. Now, I know you were talking about the RRSPs, and you can sort of use them uh, as I've known. I tell my clients about the home buyer incentive, that the first time home buyer incentive. You want to tell us a little bit more about that? I know it's got a certain amount you're allowed to pull out, and for years it has to pay back, etc. Do you want to just jump into that real quick?
Yeah. So you can use if you're a first time home buyer, you can use up to $35,000 from your RRSP. So that means that money, now we're in this wonderful period here where you can actually, we're in the new year, and I think that the time is actually done, but this is the conversations I had with people at the beginning of the year. You can still contribute to your RRSP for the previous year when you get to the first couple months of the year. And some people are like, okay, well, I'm going to do that and I can pull that out right away so I can get the tax break. It doesn't work like that. For the RRSP to be used within the first time home buyer, you have to have it there for 91 days. Okay.
Yeah.
So you cannot put it in and then take it out and expect a tax break as well as be able to use it for your first time home buyer plan. You have to have it there for 91 days. So keep that in mind, depending on where you are in the year, whether, it makes sense to maximize your tax return or whatnot. Talk to your broker, talk to your accountant, and see what's going to work best for your particular situation.
Maybe
But you can take up to 35,000. Yeah. But some people don't even know that you can actually take it out after you close on the property. There's a time, a short little window that you can take it up afterwards. So if you don't need it for your like closing costs, or you don't need it for your down payment, you can use it for it literally says for anything to do with your purchase of your home. So that could mean renovations, right? So you can take it out after you close, but just make sure you're within the window. And again, talk to your broker about what that window is to utilize that.
Yeah, that could be really helpful, because again, like if people are using all of the money except for their RRSPs, and they end up getting something that they don't really truly love, at least they have an extra up to $35,000 to do some sort of renovations or updates to make it what they want. And in some cases, that could be a new kitchen or a new bathroom or new floors. Again, the possibilities are endless, and it really opens up like sort of the options when even looking, which is like, I didn't even know that. I thought everything needed to be out before. I didn't know there was a little grace period after, but that's exactly where we have these awesome talks here. We learn a lot. So I'm just trying to think if there's any other questions about down payments. Is there any sort of things people shouldn't do?
Let's talk about investment properties. Investment properties is a hot topic nowadays. So investment properties, when you are looking for investment properties, so you are going to buy it for the purpose of like renting it out or something and having an income generating property, that is automatically, no matter what the price is, going to be 20%. So whether or not you're buying under $1 million or over $1 million, it's going to be 20% right away. There has been recent talks about that actually increasing.
Oh, really? Yeah,
Yeah.
I think I heard that too. There's all
Yeah.
the,
So yeah, there's nothing official coming out right now. I know that there were some real estate websites that had a listing that was like, based on my mortgage sources, this is what's happening. And in the mortgage community, we're like, no, we've not heard of this. Like, we've heard of it, but it's nothing official. Until it's official, we're not concerned about it, really. Um, and so, it might be coming down the pipes where you need more of a down payment. And the lenders have the purview. It's within their purview to change their lending guidelines as they see fit.
Yeah.
So, for example, when you're purchasing a property, an investment property, most lenders won't actually allow any part of that down payment to come from a gift.
Okay.
So when you're buying your own property, you can have a gift. You can have 100% of the down payment as a gift, and generally they don't say anything about that. But when it comes to investment property, it's only a few lenders that are going to be saying, hey, we're okay with a gift as part of the down payment. Most A lenders, banks, credit unions, that kind of thing, don't allow gifts as part of the down payment. So that's one thing to consider. You can use things like HELOCs. You can borrow from yourself, for example, to purchase another property. We just need to take that payment into account to do that. But on that note, what is here today might not be here tomorrow. And we saw that with COVID. There were a couple lenders, big lenders, that came out and said, hey, if you want to buy an investment property, we are no longer allowing you to borrow from a home equity line of credit. And people were like, what is going on? Right. So, always make sure that you talk to your broker. They are, well in tune with everyone that's going on and the lenders and all these different policies. So make sure before you create a situation in your mind saying, this is what I'm going to do, always talk to your broker to see if this actually is available. And this is, the current way of doing things, because things can change pretty quickly. And, that's pretty much, I'm going to be honest with you, most of part of our job is like making sure that we're in tune with all the changing policies. When it was COVID time and things were going crazy, literally policies were changing by the minute. Really? And I have 57 lenders that I work with, and trying to keep track of all these different things was insane.
Cole's notes on it all.
It's
sticky notes on
not,
the computer.
Yeah, there's not even a point of keeping Cole's notes, because the moment you write it down, it's like change. You're like, what is happening? Right. So always make sure that, like I said, some people will hear anecdotal stories or, gather around by the fireplace and share mortgage stories of like, this is what it was back in the 19 somethings. Always make sure that you always talk to a broker, a mortgage specialist, a mortgage agent, to figure out what the situation is right now, because it can be very different from like literally a couple of days from one another. So that's the best advice I have for you.
All right. So I guess the next question I have is, if, when you buy your first home, you put down the 5% down, if you decide, in a couple of years that you want to, move up, are you then required to, put 20% down instead of, or is it still 5%?
So that's really nice. You can continue to put less than 20% down as long as the property you're buying is less than $1 million. So it's not restricted to the first time you buy a house. And that's one thing that I hear all the time is like, well, it's my second house, I need to put 20% down. You don't. If it's under $1 million, you can still put less than 20% down. So again, that 5% plus the 10% of the difference. So whatever that might be, depending on the purchase price, but you don't have to put 20% down. The other part to that is that if you've already paid insurance, so again, that situation, you had less than 20% down the first property, and that means you had to pay like a CMHC insurance or whatever, Sagen or Canada Guarantee. If you buy another property and you have to pay that mortgage insurance, you can actually port that insurance and pay less the second time around, saving you tons of cash. So that's one little kind of not a loophole, but just something that is known that you can actually do and saves you a little bit of money. So you don't need to put 20% on the, the second time you buy a property, like when you move. You can continue to do that as long as that purchase price is less than $1 million.
So basically, like say if you have $100,000 equity where you sell and you have $100,000 profit, you can use just or you can just use $35,000-$35,000 of that and put it towards the next house, and then use the rest of that money, with the rest of that profit, and either to, put into other investments or have it as an emergency fund on the side, like in another account or something like that. You don't have to use that full, you don't have to use the 20%, because that could eat up all of your profit and then you really have nothing, right? So it allows them to sort of use that extra cash between the extra 15% roughly, right? So they get to be able to,
depending on the purchase price, right? So again, what you'd want to do is run the numbers and see, what's the total amount of insurance that you're going to have to pay. Sometimes, it is a substantial amount. So whether or not you want to pay that, or, depending, let's say, for example, you have that money in the stock market and you can get a 10% return or something. Does it make more sense to do it that way, or to is there a lost opportunity cost there?
yeah.
Or is it better just to, put money into the mortgage and save that money this way? So, that's where we get a little bit more advanced and we start doing some calculations of like this or that. And we can see which strategy kind of works the best.
Yeah, most of the time, real estate's the best strategy.
For me, it is. I don't, for me, I dabble with like stocks and commodities and stuff like that. But for me, I know real estate. It's tangible. I can hold it in my hands essentially, and I like it. Like I invest myself. So
you can go knock on the door. You can touch it.
Yeah,
it's real.
yeah,
It's tangible.
exactly.
All right. Well, I think that's it for the down payment questions for now. Sure, if anybody else has any questions, please leave them in the comments below. We'll be sure to get to another episode. I know I've already brainstormed a bunch of other ideas that me and Yark are going to talk about off camera. But guys, again, thanks for tuning in. Yark, thanks for joining us. If you guys have any questions, reach out to him. He clearly knows the stuff inside and out. He's a master of his craft, and I have nothing but good things to say about him. So again, thank you for joining us. And bye, guys.
Bye-bye.